Gold and silver are in a T rallying right now. They were repricing the rules of the game, and the spread is the tell the headlines can't hide. Everyone wants to make this about one scary debt number, one political headline, one tidy narrative you can file away and forget. But the market doesn't move on tidy narratives. It moves on constraints. And the constraint that matters is showing up where most people never look. In the plumbing between paper promises and real metal, in the calendar pressure that forces hedging at the worst possible time, and in the quiet institutional behavior that's been building for years and is suddenly loud. Stick with me, because later in this video I am going to give you the clean checklist for the next 1 to 2 weeks. What levels actually matter? What confirms the reset trade? What breaks the setup? And the one signal you can watch that tells you whether this is a controlled repricing or a squeeze that gets violent. Let's start with what your eyes can't ignore. In January 2026, gold has been trading in the mid-4,000s per ounce, printing fresh highs around the $4,700 to $800 zone, depending on the contract and the day, while silver has been living in the high 80s to mid-90s per ounce, also printing record territory. That's not a normal drift. That's speed. That's urgency. That's the kind of price action you get when the market is not debating any nog anymore, when it is forced to acknowledge a new set of risks and a new cost of insurance. And that's where the real pressure starts. Now here's the part you'll hear everywhere. It's just fear. It's just geopolitics. It's just a headline bid. That framing is comfortable because it implies the move is temporary and emotional, which means it can be dismissed, faded, and ignored. It also protects reputations, because if gold and silver are moving for structural reasons, funding, collateral, debt service, reserve behavior, then somebody has to admit the system is more fragile than the brochure says. And that's not a fun admission. But that's not the part that matters. The part that matters is this. When gold and silver move like this, you're watching a tug of war between paper exposure and physical timelines. And the timeline always wins eventually. Not because of conspiracy magic, because of incentives and risk management. Dealers, banks, refiners, fabricators, ETFs, futures market makers, none of them get to feel bullish or bearish when the calendar cornered them. They have mandates. They have margin. They have hedges that must be adjusted whether they like the price or not. And when liquidity thins, those adjustments can become the market. Because if this one level breaks, the math changes. So let us talk about the title. $1 trillion in debt forces a global reset. That phrase can sound like doom clickbait if you say it lazily. I'm not saying the world ends. I'm saying something more specific and honestly more dangerous. A $1 trillion interest bill, or $1 trillion scale refinancing pressure, is the kind of number that changes what policymakers can do without triggering second-order damage. It turns policy into a constraint optimization problem instead of a preferences game. It narrows the runway. It forces trade-offs that used to be optional. And markets smell that constraint long before politicians admit it out loud. In the US, credible projections and fiscal trackers have been pointing to net interest costs pushing toward, and in some framings past, the $1 trillion a year level around 2026. Separate from that, Treasury borrowing estimates continue to come in huge, with quarterly borrowing needs in the hundreds of billions and episodic periods where the net issuance requirement becomes the dominant macro event. That's not just a spreadsheet. That's a recurring liquidity event. Because every new wave of issuance is a question the market must answer in real time. At what yield, at what term, and at what confidence level is the world willing to fund the system? And that's where the reset starts. Not with one dramatic announcement, but with the slow repricing of trust. Here's the mechanism most people miss. When debt service grows, policymakers get pinned between 3 imperfect choices. Tighten into it, and risk breaking something, ease into it, and risk inflation expectations and currency credibility, or try to finesse it with communication while hoping growth bails them out. The market doesn't need you to pick one. It just needs to see that none of the choices are painless. That's why gold exists in modern portfolios. Not as a get-rich-quick trade, as an escape valve from policy constraints. And silver, when it catches a bid alongside gold, adds something extra. A supply chain that doesn't stretch on command. But the next detail is what flips the whole setup. Because the hidden detail in this whole story isn't the spot price, it's the structure around it. When the front end of the curve starts acting different than the back end, when near-dated contracts behave too tight relative to later delivery, the market is telling you something about immediacy, about availability, about who is willing to part with metal now versus later. In plain English, when people pay up for right now, it's not just enthusiasm, it's stress. Look at how futures curves can talk without saying a word. In a comfortable market, you often see a gentle contango, later delivery priced a bit higher than spot, reflecting storage, financing, carry. That's the market saying, relax, time is cheap. In a stressed market, that carry can compress, flip, or act erratically. You can see pockets where the nearest delivery month stays stubbornly bid, or where spreads behave like a coiled spring. You don't even need to be perfect about the microstructure to understand the message. The market is paying attention to the calendar, and the calendar is squeezing somebody. And that's not a vibe, that's math. Now, why right now? Why January? Why the sudden acceleration? Because January is when three things collide: fresh annual positioning, thin liquidity pockets, and a brutal calendar of policy and options-related hedging. The Federal Reserve's first meeting of the year hits at the end of January. The first regularly scheduled meeting comes with all the psychological weight of new year, new regime, whether the Fed actually changes policy or not. Markets front-run narratives. They hedge before the event, not after. And that's where the real pressure starts. Layer on top, options expirations. The third Friday monthly expiration in January already passed on January 16th, 2026, and around those windows, the options market can dominate the tape. Here's the clean version. When price approaches big option strikes, levels where huge open interest sits, dealers who are short options can become forced hedgers. They're not speculating, they're managing risk. As price rises towards strikes, delta changes. If gamma is high and liquidity is thin, the hedging itself can become fuel. You get reflexivity. You get moves that don't look rational in real time, and you get snapback risk if the pressure releases. But that's not the part that matters. The part that matters is that options-related flows can amplify what's already structurally true. Think of it like dry brush in a forest. The structural macro conditions are the dryness. The calendar is the wind. Options flows are the spark. If everything is wet, sparks fizzle. If everything is dry, a spark doesn't just make a flame. It makes behavior change. It forces cover. It forces hedges to chase. It forces liquidity providers to widen spreads. And suddenly, the price action feels like a different universe, because if this one level breaks, the math changes. Now, let's bring it back to the suppression idea without getting reckless. In every market, there are incentives to frame price moves as temporary. In precious metals, that incentive is extra strong because gold is a commentary on currency credibility, and silver is a commentary on industrial tightness plus monetary hedging demand. The system doesn't need a villain to create pressure. It just needs participants who prefer stability narratives, risk managers who hate admitting tail risks or repricing, and portfolios that are underhedged to metals. If you're underhedged, you're motivated to call the move overdone. If you're a dealer, you're motivated to keep flows orderly. If you're a policymaker, you're motivated to keep inflation expectations anchored. None of that requires cartoonish manipulation claims. It's incentives. And incentives shape messaging, but the spread doesn't care about messaging. So let's stack proof, real proof, not vibes. Proof point 1, price and velocity. Gold and silver are not gently trending. They're breaking into new territory with urgency, and the market's response has been higher trading activity in futures, with sessions where volume jumps meaningfully and open interest behavior suggests repositioning rather than just passive buy and hold. When volume surges while open interest doesn't rise in lockstep, you can be watching a combination of short covering, profit taking, and rotation rather than fresh speculative buildup. That's important because it changes the risk profile. A move fueled by forced activity can overshoot, but it can also reset the baseline higher because it flushes the wrong side positioning. And that's where the real pressure starts. Proof point 2, the curve and the right now premium. Even modest distortions at the front end matter when the underlying market is huge, because small changes in carry and spread behavior signal a shift in financing and availability. If the market was purely a headline bid, you'd often see the front end fade as soon as the headline cools. But when immediacy stays bid, when dips get bought quickly, when the market refuses to give you clean mean reversion, that's a sign the demand is not just emotional. It's functional. Someone is using metal exposure as a hedge against policy and funding stress, and someone else is scrambling to manage the risk of being short that hedge. Proof point 3, central banks. This is the most underappreciated slow force in the gold market. Central banks don't chase candles the way retail does. They allocate based on strategic reserve management. And the World Gold Council has documented that central bank gold demand has topped 1,000 tons annually for multiple consecutive years, with full year 2024 reported around 1,045 tons. That matters because it's a steady bid that reduces available float and changes the marginal seller. It's not the entire story, but it's a base layer. If you have a base layer of structural demand, then spikes don't fade the same way, because the market has fewer willing sellers at the margin, but that's not the part that matters. Proof point 4, silver supply chain reality. Silver is a different beast because it's not just a monetary metal. It's an industrial input with real-world constraints. A large chunk of silver supply is byproduct from mining other metals. That means you can't just turn on silver production because price went up. There are lead times. There are capital decisions that were made years ago. There's refining capacity and logistics. And on the demand side, industrial use has been strong, tied to electronics, energy transition infrastructure, and a broad set of manufacturing applications. The Silver Institute's World Silver Survey 2025 highlighted another year of structural deficit, with the 2024 deficit reported around 148, 9 million ounces, and industrial demand around 680, 5 million ounces, record territory. You don't have to worship those numbers to respect what they imply. The market has been drawing down for years. In a drawdown world, any surge in investment demand can hit like a hammer, and that's where the real pressure starts. Proof point 5, the street symptoms that show up off-screen. You can't always get clean, real-time inventory numbers for every node of the system, but you can observe behavior. When retail premiums stay sticky even on pullbacks, when delivery times widen, when dealers get selective about size and product types, when available becomes available but not that, those are microsignals that demand is bumping into frictions. Frictions are not proof of catastrophe. They're proof that the market is not infinitely elastic. And when the market is inelastic, price becomes the shock absorber. Proof point 6, the macro collateral narrative. When trust in the cleanliness of paper claims gets questioned because of geopolitics, sanctions risk, tariff risk, or just policy unpredictability, gold becomes a neutral asset in a way that few things can match. It's not somebody else's liability. It doesn't require a counterparty to perform. That matters more when global trade relationships get tense. And in early 2026, headline risk has been elevated, with tariff threats and geopolitical flashpoints feeding a broader sense that the existing world order is under stress. If you combine that with massive issuance needs and rising interest burden, you get a market that increasingly asks, what do I hold that an S, not somebody else's S promise? Now, let's make the reset idea concrete. Reset does not mean currency collapse tomorrow. Reset means the market changes the price it demands for confidence. It can show up as higher term premiums in bonds. It can show up as a weaker currency trajectory relative to fundamentals. It can show up as a higher gold price in the same currency because the currency is being asked to do too much at once. Fund deficits, manage inflation, absorb geopolitical shocks, and remain the unquestioned reserve anchor. The world doesn't need to abandon the dollar overnight for gold to reprice dramatically. It just needs incremental diversification and incremental hedging. A slow leak can move a big ship, but that's not the part that matters. The part that matters is what happens when the leak meets the calendar. We're in a window where markets are hypersensitive to policy signals. The late January FOMC meeting is close enough that positioning can become self-fulfilling. If the market believes the Fed is boxed in, metals can catch a bid. If the market believes the Fed will stay tighter for longer, metals can still catch a bid if that tightness threatens growth and forces fiscal stress. The trick is that metals can trade well in multiple regimes when the common denominator is uncertainty about the real value of paper claims. But you still need a roadmap because price can whip around violently even if the thesis is correct. So here's the key. Separate trend signal from noise. Trend signal is structural. Central bank allocation, debt service constraints, persistent deficits, supply chain inelasticity, and a market that keeps paying for immediacy. Noise is the intraday spike, the headline whiplash, the forced liquidation, the everyone is bullish so it must crash reflex. Noise can be brutal. Noise can take 8% out of silver in a day, even in a bull regime. Noise can slam gold $100 or $200 and make you feel like you were wrong when you read just early. The market's favorite trick is to punish you for being early and punish you again for being late, using the same two candles in opposite directions. And that's where the real pressure starts, on you, not on price. Let's talk about how that manipulation works psychologically, because this is the part that keeps retail investors from actually benefiting from being right. First, the market uses speed against you. When metals move fast, your brain screams, I'm missing it. You chase. Then the market snaps back. You panic, you sell. Then it grinds higher without you. Second, it uses ambiguity. Metals are noisy by nature. They trade macro, they trade currency, they trade rates, they trade risk. That means there is always a plausible bearish headline available to spook you. Third, it uses your need for certainty. If you demand a single clean reason for every tick, you'll get chopped to pieces. The antidote is not blind conviction. It's a process. Define what you're watching, define what confirms, define what invalidates, and size your risk so you can survive the noise. Because if you can't survive the noise, you can't participate in the trend. Now, we're ready for the hidden detail again, because now it actually lands. The hidden detail is that the market is not just bidding spot, it's bidding the obligation to deliver into a schedule. That schedule shows up in spreads, in curve behavior, and in who is forced to hedge. When the front end is sticky, when dips get snapped up, when the market refuses to offer calm mean reversion, you're not watching a story. All bias. You're watching participants respond to constraint. And constraint trades don't end politely. They either resolve into a higher plateau or they squeeze, overshoot, and then retrace violently. But that's not the part that matters. The part that matters is what comes next in the next 1 to 2 weeks. Here's your near-term roadmap, and I'm going to keep it clean. For gold, the key psychological zone is the $4,700, $4,150 region. That's where breakouts turn into either acceptance or rejection. Acceptance looks like this, a pullback that holds above roughly 4,600 and 4,650, followed by stabilization and another push where the market doesn't need constant headlines to keep the bid. Rejection looks like this, a sharp drop back through the prior breakout area followed by choppy attempts that fail, meaning sellers are finally willing to hit bids and buyers are no longer forced. The confirmation you want is not a green candle. It's behavior. Does gold keep finding buyers quickly on dips? And does the curve stay firm enough to suggest immediacy demand persists? For silver, everything is magnified. Silver is the metal that makes you feel genius and stupid in the same week. The obvious magnet is $100. Markets love round numbers. They attract option strikes, they attract headlines, they attract late buyers. That makes them dangerous. Your key zone here is the high 80s to low 90s as the battlefield, and the mid 90s to $100 as the squeeze runway. Acceptance looks like silver pulling back into the upper 80s to low 90s and holding, then grinding, then pressing again. Rejection looks like silver slicing down, failing to reclaim the low 90s, and turning the move into a deeper mean reversion. And that's where the real pressure starts, because silver retracements can be savage even in a bull. Now, let us connect this back to the debt reset in a way that is tradable without being reckless. The trillion-dollar interest narrative is not about a single cliff. It's about the market recognizing that the cost of carrying the system is rising, and the system's response options are getting narrower. When options narrow, hedges get more valuable. When hedges get more valuable, gold gets a structural bid. When that bid meets thin liquidity and reflexive hedging flows, you get the kind of tape we've been seeing. And when gold runs, silver often follows, sometimes as an undervalued cousin, sometimes as an industrial squeeze narrative, sometimes as both at once. That combo is potent, but it comes with one requirement. You must respect volatility. You must assume whipsaws. You must plan 2 scenarios, because if you only plan one, the market will teach you humility at the worst moment. So here are your 2 scenarios, base case and squeeze case, and what confirms each. Scenario 1 is the controlled pullback and retest. In this scenario, gold and silver cool off after the initial burst. Headlines fade, the market breathes. Price pulls back into key support zones, gold into the 4600s, silver into the upper 80s or low 90s, then holds. Liquidity improves, options-related pressure resets, and then the bid returns, not because the market is euphoric, but because the underlying constraint hasn't changed. Issuance remains heavy, interest burden remains large, geopolitics remains unstable, and structural demand remains present. Confirmation here is boring behavior, shallow pullbacks, quick dip buying, and a market that can rally without needing a new panic headline every 12 hours. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the market doesn't give you a clean retest. The curve stays tight. The front end stays bid. Dealers keep chasing hedges as strikes get threatened. Late shorts get pressured. Risk managers reduce exposure at the worst moment, creating forced buying. And because liquidity is never as deep as you think it is during stress, price gaps, gold pushes further into the upper 4,800s and beyond. Silver threatens $100 and the move feels too far. That's exactly when people get emotionally compromised. Confirmation here is not just higher price. It's acceleration into key magnets with stubborn dip support, plus signs that positioning is being forced rather than voluntarily added. And that's where the real pressure starts, because forced moves reverse violently when the forcing ends. Now, what would invalidate the bullish reset framing in the near term? Not a red day, not a scary headline. Invalidation is the market proving that immediacy isn't valued anymore. It's gold failing to hold key breakout areas and turning them into resistance. It's silver losing the low 90s and struggling to reclaim it. It is a regime where real yields surge decisively and the dollar strengthens in a way that forces broad deleveraging, hitting metals alongside everything else. It's a world where policymakers regain flexibility, either because inflation collapses cleanly without recession, or because growth reaccelerates enough to make fiscal math feel less tight. Those are real counterpoints. Respect them. Because credibility isn't being bullish. Credibility is knowing what would make you wrong. And here's the honest truth. Even if the macro thesis is right, metals can still drop hard. Because they're not traded by philosophers. They're traded by portfolios, margin, and hedges. If equities puke, metals can get sold to meet margin calls. If the dollar spikes, metals can get hit mechanically. If rates surge, metals can get pressured. That doesn't automatically break the long-term thesis. It can just be the market forcing weak hands out so the trend can continue with stronger positioning. But you can benefit from that if you resize like you need every day to be green. So if you're watching this and thinking, okay, what do I do with it? Here's the non-negotiable answer. You watch the plumbing, not the noise. You watch whether the market keeps paying for immediacy. You watch whether dips get bought quickly. You watch whether the curve behavior stays firm at the front end. You watch whether volume spikes coincide with open interest behavior that suggests forced repositioning rather than just frothy new leverage. You watch the calendar, policy meetings, expirations, month-end behavior, because those are the moments when positioning gets stress tested. And you don't let one brutal candle steal a thesis that was never about one candle in the first place. Because the next detail is what flips the whole setup. The market's real message is not what it says on the screen. It's what it forces participants to do behind the screen. And let me give you one more layer that matters to the trust reset idea. Especially for the skeptics in this audience. You don't have to believe in a grand narrative to recognize a simple pattern. When the cost of capital rises and the debt load is large, somebody pays. Either the government pays through higher taxes or lower spending, the private sector pays through slower growth, or holders of currency pay through a reduced purchasing power trajectory over time. Markets are forward-looking machines. They don't wait for the press conference. They don't wait for the official admission. They hedge the path of least political pain. Historically, that path often includes some form of financial repression, some form of managed inflation, or some form of balance sheet creativity. Again, not apocalypse, constraint management. And gold is the oldest hedge against constraint management there is. Silver adds a twist, because its supply chain is less forgiving. If the macro trade stays alive and investment demand stays elevated even modestly, silver can get tight in a hurry. But it will also try to throw you off the ride. It will rip, then smack you, then rip again. That's why you need the psychology shield. When silver drops 8% after nearly tagging a big level, it's not automatically the top. It's often just the market shaking out the passengers who boarded with rent money. Don't be that passenger. Here's the subtle CTA, and I mean it. If you're the kind of investor who wants mechanisms over narratives, you're already part of the small minority that can actually survive these markets. So stay with that identity. Don't outsource your mind to the loudest headline. Don't confuse volatility with invalidation. Don't confuse speed with safety. And don't confuse a pullback with a betrayal. What you want is a process and a checklist, not a prophecy. So to wrap it cleanly, gold and silver are not moving because the internet decided to be dramatic. They're moving because constraints are tightening. Debt service, issuance, geopolitics, and supply chain inelasticity. And the market is being forced to reprice what trust costs. The hidden detail is that the stress shows up in structure and schedule, immediacy, spreads, and hedging pressure, before it shows up in a comforting narrative. The calendar is the catalyst, and the next 1 to 2 weeks are about whether the market keeps paying for right now or finally gets to breathe. Watch gold's behavior around the $4,700, $4,850 zone, and whether pullbacks hold above the mid-$4,600. Watch silver's behavior around the low 90s, and whether it can keep that zone as a floor on any cooling. Keep the two scenarios in your head at the same time. Controlled retest versus continuation squeeze. And above all, remember this. The market can whip you around violently even if you're right. The goal isn't to predict every tick. The goal is to not get emotionally liquidated by noise while the structural trade plays out. We're going to keep doing this the same way. Mechanisms, proof stacks, and a real what to watch next list. Because that's how you stay solvent in your own mind when the tape gets loud.